I watched a YouTube video about a man called Adam Sullivan. He's the founder of evidence-based training, and some people might know him as Cunny or Top C for those that are joining us today. He became quite big in the media for his house purchase at the end of 2024. He purchased an $11 million property from Rob Grayer, and this is kind of where some of the problems start to snowball as to where that money came from and how he was able to put a deposit down on that. He talks about understanding what a Div 7A loan is. Now, for those playing at home, simple explanation of Div 7A, it's basically a tax rule that stops business owners taking money out of their company tax-free. Now, in Adam's case, that dollar figure ended up being close to a $6 million loan that he'd pulled from his business to himself. So to backtrack, if Adam had pulled that $6 million out and didn't turn it into a Div 7A loan, the accountant would have to declare that $6 million into Adam's name, whether it's an unfranked dividend, the payment goes into Adam's personal tax return. And in 1 year, he would have to pay tax on $6 million. Now at 45%, you imagine that's close to a $3 million tax bill on the $6 million he's pulled. But if he's put that into his property to buy the $11 million home, he doesn't have the cash. So clever accountants and good advisors will work with clients that even when they do draw some money out of their company, they have the option, as long as they do it in a timely fashion, to convert what they've drawn out as a formal Division 7A loan. Now, under this Division 7A loan, you have 7 years to repay the company with interest. 8.77% is the ATO's benchmark interest rate. So if Adam was able to formally put that loan on a Div 7A agreement, he would have to pay his own company $2.1 million interest and repay $8.1 million back to his own company over 7 years. And in an example of the first year of the $6 million loan for Adam, he would need to make just under a $1.4 million repayment, which would be just over $500,000 in interest and $857,000 in principal.
And if he doesn't make that, then that 1 year of the 7 years hypothetically is classed as income.
You basically default the entire loan process and the whole amount gets pushed out as taxable income into Adam's name.
And then he gets hit with like a $3 million tax bill.
Exactly. So then when he pays that $2.1 million of additional interest in his own company, it's basically topping up the income of his company.
Is that classed as revenue?
Correct. So that $2.1 million in additional revenue in his own company, which is interest he's had to charge to himself, becomes taxable income, which would give him an additional $525,000 in tax payable over 7 years.